Frequently, we need to make decision on a project that continue over a period of time, many years. In doing so, we are actually doing capital budgeting. So it describes decision where expenditures and receipts for particular undertaking will continue for over a period of times. Okay. So typically, these decisions involved outflows of funds in the early periods, while the inflows start somewhat later and continue for a significant number of periods. For example, we might be making decision on whether we need to expand the facilities, whether we want to develop new or improve product, whether should we replace a particular equipment, so on and so forth. A key feature here is that because the project involves a period of times, so we cannot directly compare $1 today with $1 in 10 years time. There's a time value of money in it. So $1 today is worth more than $1 tomorrow. So now we need to put cash flows originating at different times on an equal basis. So if a dollar inflow happened in 20 years times, we need to discount it back to present times so that we can compare it with today's dollar. Compare apple with apple rather than apple with banana. So we must apply an interest rate to each of the flows so that they are expressed in terms of the same point in time. There are a number of methods we can do capital project evaluations. One is payback period, accounting rate of returns, NPVs. That's the most widely used methods. Internal rate of returns. So payback period it is a time period, years necessary to recover the original investment. Suppose I'm managing a coffee shop. I want to purchase new coffee machines, invest $10,000, and it's going to take say 3 years to recover my $10,000. Then payback period is 3 years. We can also calculate accounting rate of returns, which is percentage resulting from dividing the average annual profits by the average investment. So the NPV methods is, so suppose we have a project like this. Zero, 1, 2, 3, 4 until year end. Okay, so there's cash flow starting from cash inflow starting from year 1, R1, R2, R3, R4, Rn, and there's cash outflow of O0, O1, O2, so on and so forth. Okay, then we can discount them back to present time, so on and so forth, so on and so forth, and that's the NPV. So this is present value benefit and minus present value costs. So here, a key component of NPV calculation is the interest rate, discount rate. It is also called cost of capital, hurdle rate, cutoff rate, minimum required rate of return, so on and so forth. So if in the end we calculate positive NPV, we are going to say, okay, this project is good. We should go ahead. It's financially acceptable. If it's negative, we are going to reject this project. So that's the NPV measures. We can also use what is called internal rate of returns, computing the internal rate of returns. The IRR, internal rate of return, is the discount rate that make present value of benefit equals present value of cost. So in Excel, you can use this IRR function. You can use it. Okay. So if the IRR we calculate is larger than the cost capital, for example, the IRR associated with my project is 8%, and I'm going to finance this project by loan from the bank. Bank charge me 5%, so 8% is higher than 5%. Then yes, we should go ahead with this project. If say bank charge me 12%, then it's going to be no, we shouldn't go ahead with this project because the IRR is only 8%, lower than the 12%. So when we are evaluating only one project and using IRR and NPVs, we are going to get the same results. NPV is positive, that means IRR is bigger than the cost of capital. If it's zero, then IRR is the same as cost of capital. If it's negative NPV, then IRR is less than the cost of capital. However, if we are assessing more than one project, IRR and NPV will give the same results if these projects are independent, which means we can implement projects simultaneously. We have sufficient fund of it. We don't have capital rationing. And implementation of one project does not affect the cash flow of the others. Okay. In such cases, if these projects are independent, then IRR and NPV results in the same decision. In contrast, they might end up in having different decision if we are assessing mutually exclusive projects. So this disparity might occur if the initial cost of proposal differs, the shape of cash flow inflows, the shape of the cash inflow streams differs. Okay, and sometimes when we are using IRR, we might end up in having more than IRR. Okay, so this is a particular case if we are assessing a project with non-conventional cash flows. So in practice, NPV is the most recommended methods to assess a project. Right, in assessing a project that lasts for many years, the most difficult task is to enter the best estimate of cash flows in the future. Okay, so future timing and the amount of cash flows are uncertain. In such cases, we need to use data from organizational entities, other organizational entities. We are going to examine this data for potential bias. For example, market forecast might be biased upward. Costs are often underestimated. All right. When we do not have sufficient fund for all desirable projects, we end up in a situation we call it capital rationing. It is the practice of restricting capital expenditures to a certain amount, perhaps due to limits on external financing. For example, there may be a reluctance to incur increasing levels of debt, and the management might not want to add equities in fear of diluting the controls. So now, such kind of capital rationing does not permit a company to achieve its maximum values. Right. Okay. So in the capital budgeting, there's risks. So we need to incorporate risk into capital budgeting problems. So what we do is, one way we can do is calculate the expected NPV, then calculate the standard deviation of these NPVs. Okay. So expected NPV, suppose there's only cash outflow in time 0. So this is already present value. And let's calculate expected cash inflow in each period. Discount it back, get the expected NPV. Okay. And we also calculate the variance associated in each period using the methods we did in previous videos. Discount it back, but now you want to be aware that the unit of the variance is $squared. So now we need to have 2t here. Then sum them up, then square root back. We get a standard deviation of these NPVs. Okay. That's one method. Second method we can account for risks is to use risk-adjusted discount rate. So now the discount rate K here is a risk-free rate plus a risk premium. For example, we might be able to use capital asset pricing model to determine what risk premium is. But I won't go into the details of this. Third method of accounting for risk is computing certainty equivalent cash flow, certainty equivalent cash flow. A certain risk-free cash flow that would be acceptable as opposed to the expected value of risky cash flow, and using this certainty equivalent cash flow and computing the NPVs. So with the certainty equivalent methods, the risk adjustment is made in the numerator of the present value calculations. Okay. We can also account for risk in sensitivity analysis or scenario analysis. Sensitivity analysis is a method for estimating project risk that involves changing a key variables, only one variables that we have uncertainty, with which we have uncertainties, to evaluate the impact of the change will have on the results. So suppose my project is to I'm going to assess for my firm is to develop a new product, and one uncertainty of this project is we are not sure about the price for our new product. So we can create different say if price is high, price medium, price is low, and calculate the associated NPV and compare them. We can also use a scenario analysis. It's similar to sensitivity analysis, but takes into consideration the changes of more than several important variables simultaneously, rather than just one. Okay. Right. Let me conclude this video by make you aware of this Trade Practices Act 1974. Two main parts are quite relevant to this subject, which is Part 4, which deals with anti-competitive practices. Part 5, it deals with unfair trading practice. If you are interested in this act, you can Google it up. It's publicly available.